at True Trading Group. Today is January 15th. I'm in a bit of a pickle. I'm in a bit of a pickle with a position that I'm in. It's a swing trade. I'm going to discuss this with you, but first, this video, I'm going to talk to you about options trading, and I'm going to go over some basic options information for those of you that are new. I get a lot of comments from people that ask me about options. I'm going to cover some basics, but really the bulk of this video is going to be discussing with you how to roll forward an option contract. Okay, how to roll forward an option contract. What does that mean? What are the benefits? What are the cons? When are times that you're going to want to maybe do that? And how is that actually done? And what is it? And what does it actually mean? Okay, that's what I'm going to cover with you guys in this video. So for those of you that are experienced options traders, bear with me in the beginning of this video because I'm going to talk about some option basics, and then I'm going to get into how to roll over those contracts. And in doing so, I'm going to tell you about the trade that I'm in. Before I do get started, guys, also there is part of the TTG curriculum is an entire options trading course. So if you guys are interested in learning how to trade options, I have an entire course that gets into the details and the nitty-gritty meat and potatoes of trading options on the TTG website in the curriculum for all members. If you guys are interested, you can click on the link in the description below and get a special discount just for being part of the YouTube community. Now, getting into this option trade, I bought some SPY put options. If you watched my video from the other day, I bought SPY put options. The other day, I bought the 327 strike January 17th expiration put option at 90 cents a contract. I took 25% of that position off the table yesterday at $1.30. That's like a 40-something% gain on 25% of the position, but I still was holding the bulk of that trade. What I was thinking, my thesis in this trade was that the market has rallied up to this point on the back of a trade deal, a phase one trade deal with China, all the while not knowing what is actually in this deal. So my thought process was that this could be a buy the rumor, sell the news type of trade. I talk about this in my video from yesterday. Go back, check it out. If you missed it, it's a really, really, really great video yesterday, guys. I really highly recommend that you check it out. But aside from that, the thesis on the trade was me thinking that once the deal is signed, the market might be a little disappointed with what is actually in this phase one deal, that maybe there's not enough in there to really warrant this huge move in the market. And now that the expectation and the hype leading up to the signing of the deal is finished, I felt like profit taking would kick in and the market would start to pull back in. I'm not looking for an aggressive sell-off. I was looking for a market to pull back in and reset. The market's been on fire. I feel like it's starting to overheat. And I was just looking for a little pullback. I mean, to see what the market's done since October, after we found out that we have a phase one agreement, I mean, the market has just basically gone straight up with one day of a pullback. Other than that, the market's just gone straight up. So I was thinking that today would be a perfect day for some profit taking to kick in. So I bought these put options yesterday. Now today the market pushed higher. My contracts expire on Friday, and we were not getting the sell-off and the pullback that I was looking for. So what I did today was I rolled my contracts forward to a further out expiration. That's what it means to roll a contract forward, meaning you're extending your expiration. Now, before I get into more details about rolling your contracts forward, let's talk about some basic option trading and some basic terms and some fundamental things that you need to understand about options trading to be able to fully grasp what I'm about to share with you about rolling the contract trade forward. When trading an option contract represents 100 shares of the underlying stock. So if you buy a call option in Tesla, you are buying the right or control. You're buying control over 100 shares of Tesla. Traders with small accounts love trading options because it allows you to take advantage of and participate and profit from movement in large cap stocks for a fraction of the money that it would cost you to actually own those shares. So for you to buy 100 shares of Tesla would cost you a very large amount of money, trading at 500. What is it? Let's see what we're at right now. I haven't even seen $522 a share. Okay, so the average trader doesn't have enough money in their account to be able to buy 100 shares of Tesla. Now, I trade Tesla all the time, but I trade with a large account. Not everybody has large accounts, but people still want to be able to take advantage of the movement in a stock like Tesla. And a way to do that is to buy an option. All right, you can buy an option contract in Tesla that gives you control over those same 100 shares for a fraction of the money. It can cost you $1,000. It can cost you $2,000 to control the same 100 shares in Tesla. Okay, that's why options are such a great tool. It's actually very common for you to see a 100% move in an option contract in a day. That's actually very common. But with that extra reward comes potential extra risk. So before you start trading options, it is critical that you understand stock trading first, because an option contract, their price will fluctuate based on what the underlying stock is doing. So if you own a call option in Tesla, a call option is a bullish bet, meaning you think the stock's going to go higher. Buying a put option is a bearish bet. If you buy a put option, you think the stock's going to go lower. So by buying a call option, you think Tesla's going to go higher. So as Tesla goes higher, the value of that contract will increase. If Tesla goes lower, the value of that call option will decrease. On the flip side, if you buy a put option in Tesla, as Tesla's stock price goes down, if the value of the put option is going to go up. If Tesla goes up, the value of the put option is going to go down. So you have to make sure that you understand stock trading first before you start trading options, because with options, there's extra factors that affect the cost of that contract, like time value, time decay, implied volatility, and a lot of other different terms that I'm not going to get into in this video for the sake of time on this video. I'm just going to talk about the core basics. Okay, the options course on the website goes into all great depth and detail about options trading and all the different factors that affect the price of an option contract, but I'm just covering the basics with you right now. When you're buying an option contract, you have to select a strike price and an expiration date. The strike price is you saying that by the expiration date, you think that the stock is going to be either at or past your strike price. So if you buy, let's say, a $550 call option that expires on January 17th on Tesla, that's you saying you think that by January 17th, the closing bell of January 17th, you think Tesla is going to be at or above $550. The call option gives you the right to purchase Tesla at the strike price. So it gives you the right to buy Tesla at $550 at the closing bell on the 17th. That's what you're buying. You're buying the right to do that. You're buying the option to do that. Okay. So the further Tesla goes higher, the more valuable that contract's going to become. So if Tesla, let's say on the closing bell of January 17th is at $558 and you own a contract, an option contract that gives you the right to buy Tesla at $550, that contract's going to be very valuable because the stock is trading at $558, but you have the right to buy it at $550. So then that contract becomes very valuable. And that's how you can take advantage of movement in large cap stocks with a fraction of the money by buying these option contracts. Now, there's two things that you need to know about options. Guys, bear with me. I'm almost done with the basics. Then we're going to get into rolling over option contracts. There's two different values that you need to understand. There's intrinsic value and extrinsic value, which is also called time value. Intrinsic value is how far what's called in the money is your option contract. In the money means the stock is past your strike price. So in the example what I'm using with Tesla, a $550 call option, if once Tesla goes to $550.01, that contract is now in the money. The underlying stock is now trading past your strike price. So as the stock goes higher, 551, 552, 553, the intrinsic value on that contract increases. So if your strike price on a call option is 550 and Tesla's trading at 555, that contract is going to have $5 of intrinsic value. So at the absolute bare minimum, the contract will be worth $5 a contract. The other factor that is included in the price of an option is something called extrinsic value or time value. This is how much time do you have until your expiration date. So the more time that you have until your expiration. So let's say in the example that I'm using, January 17th expiration, which is Friday's close, I still have a couple days before that contract expires. Those couple days, okay, the chances of Tesla reaching the strike price, the more time the stock has, the greater chance it has of reaching that strike price. So the time value is going to be greater. As you approach expiration, the chances of that contract going into the money and reaching that strike price start to decrease because the stock is what's called running out of time. This is called time decay. So the closer that the contract gets to expiration, that time value that we just spoke about starts to get closer and closer and closer and closer to zero. When a contract expires, it'll have zero time value, and the only value on that contract is what's called intrinsic value, which we just talked about. So if Tesla closed on January 17th at $555 and you're holding a 550 strike call option, your contract, the closing bell, will be worth $5. Now, let's say tomorrow Tesla reaches $555 and you're holding a 550 strike call option that expires on Friday. You still have an entire day of expiration, so you're still going to have time value. So when the stock's trading at 555, then tomorrow when you hold that 550 call option, your contract's going to be worth $5 of intrinsic value plus time value. Maybe the time value is an extra $2 or $2.50. So your call option is going to be worth $7, $7.50. And then let's say the stock stays at 555 and doesn't move. By the closing bell on Friday, that 250 of time value will decay to zero, and you'll be left with a $5 contract or $5 option contract. Okay, that's all intrinsic value on your call option. The exact opposite is true for a put option. Okay, the stock needs to go below the strike price to be in the money for a put option. It needs to go above the strike price to be in the money on a call option. Okay, those are the basic fundamentals of options trading and how they work. All right, I can spend hours upon hours upon hours on going through options trading with you. That's not for the YouTube channel. That's for the options trading course that's available on the TCG website, part of the TCG curriculum. So if you guys are interested in the all-inclusive membership that gets you access to all of the trading courses, as well as the chat room and all the trade alerts, you can get a special discount. Click the link below, because the YouTube community, I'm giving a special discount because I love you guys, because you show me so much love. And since we're talking about love, smash that like button, give me a comment, follow, and definitely make sure you flip the notification bell so you don't miss any more of these awesome videos. All right, now let's get into what's called a roll forward. Roll forward is something that you would want to use if your timing is a little bit off, or your expiration is approaching and you're in the money and you think the trade's going to continue in this direction. You want to stay in it. So like I said, every option contract has an expiration date. It'll expire. So if you don't want to exercise the option, so let's say you own one call option in Tesla with a $550 strike price. If you let that contract expire, then you're going to have the option to actually purchase those shares. So you'd have to buy 100 shares of Tesla at $550. Now, if you don't have that kind of money in your account, you need to sell that contract before it actually expires. Okay. So in an event where, let's say you are still confident in a trade, but your contract is expiring today, you might want to roll your contract forward and buy a new contract with a further out expiration date that's still live and is still open. Okay, this is usually a simultaneous transaction that's done with your broker, where you would close out your current option contract and simultaneously open a new contract at a later expiration date. You can either do the same strike price or a different strike price. So what I did today was I took my $327 strike price put option in the SPY that expires on Friday the 17th, and I rolled it forward into a 328 strike price put option that expires on January 22nd. So I'm giving myself more time and more flexibility with this trade because I did not get the pullback that I was looking for today in this buy the rumor, sell the news type trade. Now, I thought I was golden here. We started to pull in going into the close, and I thought I was golden. At this point, I'm like, I am so good on this trade. If we close red, I think we gap down tomorrow and we get that pullback down to my target on this is going to be down here to 326. Okay, that was going to be my target on this trade, and I thought I was money when we were having this pullback, and I was getting pretty excited because when you go to the daily chart, if we put that close in, if the SPY closed right here, because that's where it would have closed, and put in a red candle and a big tail, then these two candles together would be a topping signal, and you would expect a pullback tomorrow down towards 326.50, 326, and that would send my 328 strike put options soaring. Okay, they'd be soaring because if I've got 328 strike put options and the SPY's at 326, that means I have $2 of intrinsic value because we're $2 below my strike price. So I've got $2 of intrinsic value, but my contracts don't expire until the 22nd. So I've got a lot of time value still on that contract. So I'm going to be, you're talking about a real big possible gain of, big triple digit gain if that was to happen tomorrow. That's what I thought we were going to get. But you can see right before the bell, the market bounced right back up. So this is what I meant by when I started this video. I'm in a bit of a pickle. I'm a little nervous here. I'm kind of starting to feel like this market is still not done. I feel like we might gap up to all-time highs tomorrow. If that's the case, I'm going to be left with a very difficult decision, which is to either do I stop out of this put option trade or do I hold on, considering that my contracts don't expire until Wednesday of next week. Okay, so I'm going to be faced with a very tough decision if we do gap up to all-time highs tomorrow. If we gap down, then I'm sitting pretty because if we gap down, I'll most likely be in the money on those contracts. I'll have a lot of time value left and I can let the market do what it's going to do and see if we get that pullback. But today's action going into the close does not make me feel warm and fuzzy about this trade. I do not feel good about it as I'm making this video, but I wanted to share with you what it means to roll your contracts forward and how you go about doing that, because it's something that I don't think I've ever talked about on the YouTube channel, to be honest with you. And I get a lot of questions about people when it comes to trading options. Some of my biggest winners ever percentage-wise are option trades. Like I've had, in 2019, I had like a 460% gain on a Tesla option. I had like an 800% gain on a Tilray option. There was another like 600% gain, I think, on a Beyond Meat option. I don't remember the exact numbers, but there were huge percentage gains. Those are some of the biggest gains percentage-wise in my career, and it's done through options. So that's why I get a lot of people that whenever I post like a video about a huge option trade, I get so many questions about that. So I wanted to come on, make this video, explain this to you. I hope it helps. If you're brand new at trading options and you've never done it before, make sure you know how to trade stocks first. And then I would highly, highly, highly recommend going through the options course that's available on the website, guys, because it's a really, really in-depth, excellent course that can help you guys learn how to trade options and take advantage of that vehicle. I think options are something that everybody should learn how to trade because, like I said, large account traders and small account traders love trading options because of the flexibility and the potential profit. But like I said, with that potential profit does come extra risk. So you got to make sure you know what you're doing. Don't just start trading options, with trial and error. Don't just start trading options and you don't know what you're doing, because you can lose a lot of money very quickly in options. So please do not watch this video and say, I'm just going to go start trading options tomorrow and you don't know what you're doing. I promise you're going to lose money. So please, please, please learn how to trade options first and then go ahead and start to attack. I'll update you guys on this trade. We'll see what happens. Like I said, I don't feel good about this SPY trade, but I did roll those contracts forward. Again, I got the 328 strike put options on the SPY that expire on the 22nd. I've got those contracts from $1.17 a contract. I'll let you guys know what happens as we go forward, and we'll see what happens tomorrow. Take care, guys.